Welcome to the deep dive. Today, we're really getting into the weeds of long-term investing strategy.
That's right.
We're looking at insights from a young investor, Michael Kuhl. We've got excerpts from his YouTube video transcript, Why Most New Investors Fail My Long-Term Investing Strategy.
A good starting point.
And look, this is for you, the listener, who wants to, get up to speed quickly on this stuff without feeling totally overwhelmed.
Absolutely. Our mission, if you will, is to pull out those key nuggets, things about planning, picking stocks versus funds, growth, risk.
Exactly, like understanding beta, comparing Apple to maybe the S&P 500, all to help you become a more informed investor faster.
And Michael, he's young, only 20, thinking 30 years plus ahead. It's quite a perspective.
It really is. Okay, so let's dive in. Right off the bat, he says the biggest mistake new investors make is, well, just not having a plan.
Seems basic, maybe, but apparently it's a huge pitfall.
Yeah. He thinks for long-term folks like him, that plan is just critical. Why do you think that's such a common stumbling block?
Well, I think a plan acts like your North Star, right? The market gets choppy.
Oh.
Without a plan, you might panic sell or chase the latest hot stock. It's reactive.
Okay, yeah.
A long-term plan keeps you focused on your goals. It helps you decide what kind of investments actually fit your strategy. It's like planning a cross-country drive for yourself. You need the map, the destination.
Right, you wouldn't just hop in the car and hope for the best.
Exactly.
So that brings us to the big decision. Individual stocks or something broader like an S&P 500 index fund. Michael says lots of newbies just buy what they know, like Apple's his big example. But they don't really dig into, future growth, what analysts are saying.
Precisely. And the takeaway there for you listening is that popularity isn't the same as future potential. A familiar name feels safe, maybe, but will it give you the growth you need over, say, 30 years? Maybe not.
Right. So his own strategy, it's pretty clear. He picks individual companies he genuinely thinks will beat the S&P 500 over, like, the next 5 years, aiming high. But here's the really interesting part. His minimum expectation, his worst case for picking a stock, is that it should at least match the S&P.
Which is a fascinating approach to risk management, isn't it?
Yeah. And he still keeps about 20% of his money in the S&P 500 anyway, kind of like a baseline.
It's smart. That worst-case thinking shows maturity. He gets diversification from the index, but takes calculated shots with individual picks. For you, that highlights how you can blend strategies.
Okay, and he brings up beta. Sounds a bit jargony.
It can, yeah.
But he explains it simply. It's just how much your portfolio tends to jump around compared to the whole market, right?
Yeah, exactly. Higher beta means bigger swings, both up and down, relative to the market average.
And because he's got, 30 plus years, he's comfortable with those bigger swings. Higher beta more, well, he calls it risky.
And that time horizon is absolutely crucial for you to consider. If you got decades, you can potentially ride out more volatility. Someone near retirement probably wants a smoother journey.
That makes total sense. Okay, let's get into his examples. First up, Apple, the classic first stock purchase for so many.
Right.
He's not dissing Apple, but he questions if it has the high-octane growth needed to really smash the market averages for his long-term goals.
And he uses the numbers to make his case, which is key for you to learn from. He notes revenue growth was, only 2% last year?
Yeah, something like that. And projected maybe 4% over the next 5 years.
Not exactly explosive growth, is it? Earnings per share, also kind of flat recently.
So even a giant like Apple might be more of a steady ship than a speedboat, growth-wise.
That seems to be his implication, yes. Especially relevant if you're aiming for significant outperformance.
Then there's the PE ratio, price to earnings. Apple's was pretty high, he said, around 32, though maybe down a bit now.
And the significance of that for you is, a high PE means you're paying a premium for those earnings. If growth slows, it's harder for the stock price to keep climbing unless that PE ratio stays really high or goes even higher.
Which feels like a bigger gamble if the underlying earnings aren't growing super fast.
Exactly. It adds another layer of risk.
He even ran a sort of best-case scenario, like 6% earnings growth per year, PE stays way up at 35.
Yeah.
Even then, the projected return was only around 8% a year.
Which is pretty much the historical average return of the S&P 500 itself.
Right. So his question is, why take the risk of owning just one company if the potential reward is basically the same as owning the whole market through an index fund?
Very valid question for you to ask yourself. It pushes you towards thinking about diversification. He does mention a bright spot for Apple, though.
But yeah, the services side. App Store, Apple Music. That's growing over 10%.
So they are finding other revenue streams, leveraging that massive user base.
But the main engine, the iPhone, seems mature, maybe? Needs something big and new to really reignite massive growth cycles.
That seems to be the concern, yes. How much more growth can you squeeze out of the current model? He also notes Apple is predictable, consistently beating Wall Street estimates.
Which is good, I guess. Predictability.
It reduces uncertainty.
Like that.
But the core question for you remains, is steady but moderate growth in a mature company the best path to beat the market long term? Or is diversification via an index safer for similar expected returns?
Okay, good contrast. Now, his other example, Google, Alphabet.
Right, his tech pick instead of Apple.
And the first thing he flags is valuation. Google's trading lower than Apple. PE was like 19 trailing, 17 forward. He called that potentially cheap.
And for you, a lower PE can mean a better entry point, potentially more upside if the company delivers and the market re-rates it higher. Less price for perfection, perhaps.
And the growth story looks different, too. Revenue growing over 10% year over year, expected to continue.
Yes, significantly faster than his Apple numbers. And he mentioned operating leverage.
Right, what does that mean, simply?
Basically, as revenue grows, their costs don't grow quite as fast. So more of each extra dollar of revenue falls to the profit line to boost earnings growth.
Got it. And Google's got more diverse businesses, right?
Absolutely. Their search, obviously still huge and growing despite AI competition.
Which is surprising, kinda.
It is. Then YouTube, massive. Google Cloud is now profitable and scaling up fast. And the moonshots like Waymo, self-driving cars.
So multiple potential growth engines compared to Apple's main reliance on the iPhone ecosystem.
That seems to be his argument. More shots on goal, perhaps. Even with challenges like LLMs hitting search, the core business is still growing well.
So looking ahead, Wall Street thinks Google can grow earnings per share, maybe 15% a year.
Around that, yes. That's the consensus expectation he cited.
So Michael runs the numbers again. 15% EPS growth, maybe a PE of 22. That could mean potential returns around 17% a year.
That's the potential upside he calculated, yes. Significantly higher than the Apple best case or the S&P average.
And even if growth is slower, say 10, 12%, he still thinks it could beat or match the S&P.
Right. So for you, the takeaway is seeing how analyzing growth and valuation together can point towards potentially higher returns, even with perceived risks. Don't just look at the brand name.
Which ties back to his whole worst-case scenario idea.
Exactly. He picks things like Google, where he sees strong potential, but feels even the downside case should hopefully track the market.
And if it doesn't work out long-term,
His plan B is simple. Move that money into his S&P 500 allocation. It's a disciplined approach. Takes the pressure off having to be right every single time.
yeah, that's a sensible safety net. Now, quickly, he mentioned taxes. Big deal for long-term investors, right?
Oh, huge. Especially for you if you're investing outside of tax-sheltered accounts. Holding investments for over a year means you usually qualify for lower long-term capital gains tax rates.
Instead of your regular income tax rate if you sell within a year.
Precisely. That difference really adds up over decades. It's a major incentive for that buy and hold approach.
Good point. And finally, he mentioned wanting to do future videos on things like net income per share, free cash flow.
Just showing that the analysis can go deeper. Those metrics give you more insight into actual profitability and the cash a business generates, which is vital for long-term health.
It's not just about the top-line revenue or the stock price hype.
Definitely not. It's about understanding the underlying financial engine of the company.
Okay, so let's wrap this up. Key takeaways for you, the listener. First, you absolutely need an investment plan. That seems non-negotiable.
Your compass.
Second, understand the difference between picking individual stocks, analyzing their specific growth, risks, valuation, versus the broad diversification you get from index funds.
And that choice depends heavily on your goals, risk tolerance, and time horizon.
Third, look beyond just the company name. Dig into the fundamentals. Revenue growth, earnings potential, PE ratio, business diversity, like the contrast between Apple and Google here.
Michael's approach really emphasizes that fundamental analysis, even with a very long-term view, and that worst-case scenario planning adds a layer of practical risk management.
So the final thought we want to leave you with is this. Based on this deep dive, thinking about Apple versus Google through Michael's lens, what criteria will you now put at the top of your list when you look at potential long-term investments?
Yeah, how does that fit with your comfort level for risk and what you want to achieve? And maybe, what other questions does this raise for you as you continue on your own investment journey?
Something to think about. We'll leave it there for this deep dive. Thanks for tuning in.